Hello guys, welcome to Bhavna's Online Academy. So in this video, we are going to learn AS15 which speaks of employee benefits. So before we move into this standard, let me tell you that this one is a newly introduced standard in the CA Inter syllabus. It used to be there in the old syllabus and now they have brought it into new syllabus as a part of CA Inter. So in this video, we are going to cover, in part 1 of the video, we are going to cover all concepts related to AS15, and there will be a part 2 to this video which will cover your all illustrations and test your knowledge questions from your ICI study material. So please make sure to watch till the end, and I will guarantee you that AS15 will seem very easy to you. And the handwritten notes that I'll be using today in the video will be available in my Telegram channel, the link of which will be available in the description box below. Yes, so without any further ado, let's begin. So AS15, it speaks about employee benefits. Yes. So what does employee benefits mean? That will be your first question, right? So here they are telling when there is an employee and there will be a boss, correct? There will be a person who works in a company who will be called an employee, and there will be a boss of the company who will recruit the employee to work under him. So this boss we also call as what? Employer, and he is known as the employee. So whatever consideration this boss or this employer pays to the employee, whatever consideration, that means all forms of consideration. Here they say that all forms of consideration which is given by an entity in exchange of services. So what this employee will give? This employee is going to give the employer some services. He'll work for him, against which he'll get some payment, correct? So against such services, whatever payment this employee is going to receive, all those payments are going to be called as your employee benefits. So here they have said that all forms of consideration given by an entity in exchange of services rendered by the employees. So employee give the services and they get a payment in return, which is known as the employee benefits. Okay. Here they are telling you AS15, specifically the standard, is going to deal with how to account for such employee benefit and how to disclose it in the financial statements in the books of employer. The company, how they should record it in their books, that is what we are going to understand today. And they are saying except, so this employee share based payment ESOP that we read, no, that is not covered under AS15, that will be dealt separately, correct? So except this, all of the forms of consideration is covered by AS15. Okay, I hope the first 2 points are clear. So moving on to the third point, they say that employee benefit, why will one employer? So here they are asking, why will this boss pay anything to his employee? What is the obligation? Why do they need to pay? Because the employee is going to render what? They are going to render service, so for that they are paying. So that can be due to a plan or an agreement, maybe some joining agreement that employee would have made, in which agreement it would have been written that, if you work for this company, this much amount of money will pay you every month. So it can be because of a formal plan, or it can be because of an agreement, and then it can be because of a legislative requirement. That means, suppose you get bonus from the company. Okay, in the law they would have told, no, that every employee deserves 10,000 rupees of bonus a year. So because of legislative requirement, that means because of law also, you may get some form of consideration which will be your employee benefit again. And then it also may be due to some informal practices. You would have seen, in a few firms or in a few companies, they'll give, Diwali bonus or a year end bonus. Yes, so they'll give like a 1 month pay. So whatever the employee is earning for 1 month, that same amount they will give as bonus to the employee in terms of a Diwali bonus or something. So here, this Diwali bonus, suppose it is not told by the company to you. You have newly joined in the company and this has not been told by the company. It is not written in the agreement, nor it is required by law for the company to pay you Diwali bonus. But what happens is, because the company is paying this Diwali bonus, because this company is paying this Diwali bonus every year to all the employees for the past 50 years, so the employees will also expect that this year also they'll get this Diwali bonus. For past 50 years they are paying every year. So even if it is not said, it is implied that this employees will get Diwali bonus this year also. So this is because of informal practices, that it's not written anywhere or there's no requirement, but the company is doing on its own. So the company has created, so here they say, here the pattern has been created such that there is an expectation among the employees that the company will pay them such Diwali bonus. So employee benefits is paid due to three reasons. One, you have an agreement. One, there is an informal practice, or it may also be due to a legislative requirement. That means it may be required by the law. Okay. Next, we are going to understand what are the types of employees covered. Okay, what kind of employees are covered in this? All kinds of employees are covered. They may be working full time in the company, part time in the part time in the company, or they may be the whole time directors or a casual staff. That means for a particular project they have been recruited. After the project is over, they'll be taken off the company. Yes, so all kinds of employees are included under this employee benefits or AS15 in particular. Okay, here they are saying there might be some employee benefits. So what are the examples of employee benefits? Before I move on to the standard, let me tell you what are the examples of employee benefits. Anything which the employee gets from the company. It can be salary, it can be wages, it can be bonus, okay, gratuity, pension. So all these, whatever the employee receives, will be known as a employee benefit to him in against of the service he is providing. Okay, fine. So here they are saying that this employee benefits which is given to the dependents, that means to the family also they are giving some employee benefits. So I am working in a company, not only to me but also to my parents, to my dad and to my mom, to that means to my father and mother. To them also the company is paying some employee benefits. Suppose what happens is the company is paying some insurance premium for me, my father and my mother, for all three of us. So here there is some employee benefit which is given to the dependents also, dependents of the employee. So it can be their spouse, it can be the children, or it can be anyone else. Yes, so that will also get covered under this AS15 as employee benefits. Okay. And finally, the payment can be made to anyone. It is not necessary that the payment should be made to the employee only. The payment can be made to the employee, the payment can be made to the dependent, or the payment can be made to others also. Suppose insurance premium they are, paying for the dependent. Suppose there is a, let's take an example here. Yeah, suppose this is the company side. Okay, there is this employer. The employee is paying a particular insurance premium. The company is paying a particular insurance premium to the insurance company. Okay, and for whom this insurance premium is being paid? It is paid for me, my father and my mother. Okay, so here what happens? Here the employee benefit, this insurance premium is not being given to me or my dependents also. It is being given to a third party, which is an insurance company. In such case also, since it is given for my benefit or my dependents benefit, in that case this will also be counted as an employee benefit only, even though I am not directly receiving it. Okay, that means the employee is not directly receiving it. Okay, so the payment can be made to the employee, dependent, or others. It can be the legal hire, insurance company, etc. Okay, so I hope you understood these two things. And finally, in what form can they pay? They can either pay you in cash or they can pay you in kind. Okay, yes, so this was about why is the employee benefit being paid, and who are the types of employees covered, and what kind of employee benefit can be given, only cash or it can also be given in kind. Maybe they are giving you some, instead of Diwali bonus 10,000, they are giving you 10,000 worth of crackers or something like that. Yes, okay, done. Here finally they are saying, related to employee benefits, this is a very important point. Here they are saying that it should be a contract of service and it should not be a contract for service. Contract for service means it's an example that you're getting a particular service from a professional. Okay, here there'll be no employer employee relationship between them. Yes, here whereas when you speak of contract of service, that means to provide service there'll be a contract. It will imply a employer employee relationship between them. Okay, so whatever this employer is going to tell, this employee will have to listen, no other go. But in contract for service, suppose you are hiring a lawyer for your company. Okay, this is a professional service which you are getting for your company. But here whatever you say, will the lawyer listen? The answer is no, because he is providing a professional service to you. This is a contract for service, and here it's a contract of service, whereas the employee will have to listen everything the employer says. Okay, so in AS15, contract of service is only covered, contract for service is not covered. Okay, remember this. So this was all your basics about employee benefits. Okay, So now we are going to understand what are the types of employee benefits. So there are totally four types of employee benefits. One is short term employee benefit, long term employee benefit, post employment benefit, and terminal benefits. Now what is the difference between each of it? Okay. So let me make you understand. Okay. So this is your current year. Okay. So what happens this whole year you're working, this whole year you're working. Fine. So whatever whatever employee benefits will be payable to you within 12 months from the end of balance sheet date. That means from the year end within 12 months. Within 12 months itself, if any employee benefits will be payable to you, that will come under short term employee benefits. Suppose the salary of March. Suppose March 31st is your year and the salary of March will come in April. So within 1 month itself, it is getting paid. That means within 12 months itself, it is getting paid from the end of your year end or from the balance sheet date of current year. So in such case, it will be known as your short term employee benefits. Your examples for this can be your salary and wages. Okay. Then next comes the long term employee benefits. So what does long term employee benefits mean? So this is the current year which is going on, and then there is a, so this is the current year, this is the next year, and after the next year is ending, after that only you will get the payment. After here only you're going to get the payment. That means this is payable after 12 months from the balance sheet date of current year. That means current year has ended, 12 months has also again gone by, and after this 12 months if any payment you're getting, that means in this period, then in such case that will be known as your long term benefits. Okay. Yes. So for this example can be a sabbatical leave. So here your question might be, what does sabbatical leave mean? So basically there may be more examples for long term employee benefits, one of which given in your book is sabbatical leave. It means nothing but like an extended break that you take, a long break that an employee takes for any purpose. It can be example, it can be example, the purpose may be for further education. So what few companies does is, if the employee has suppose worked in the firm for 3 years, to upgrade his knowledge more, they will send that employee to 6 months of 6 months of educational training. If the employee wants to get more upgraded with his knowledge and everything, they'll send him for further education from the company itself. So here what will happen is, in the current year this benefit you are not getting, in the next 12 months also this benefit you are not getting, after that you're going to get that benefit. After the next year, after the 12 months has ended, you will get this benefit of extended break to go for further education. So this will come under your long term benefits. Okay. So your benefits need not be only in kind, it need not be only in cash, it can be kind also. So this is one of the examples for such kind. Okay. Next is post employment benefits. So here what you have to remember is the short term and long term employee benefits both were paid during the employment period, that you're still in employment and you're getting the short term benefit and this long term benefits. The next two we are going to talk about is not during employment, it is either after the employment has ended or at the date of retirement. Okay. So first let's start with post employment benefits. So post employment benefit means the person is retiring. Okay. And that on his retirement or after his retirement, if you are paying something, then in such case it will be known as post employment benefits, which can be pension. So monthly or yearly pension your grandmother would get, no? So this is after their retirement from the job, they are getting this particular pension. Yes. So this is an example of post employment benefit, which they either get on retirement or they get after retirement. Example is gratuity, pension, etc. Okay. And finally, the fourth type of employee benefit is terminal benefits. So terminal benefits means it is paid for termination. That means they are not, retirement here means the employee by himself is leaving the organization and going off. Termination means the entity is throwing him off. Here he himself is not going, the entity is throwing him off. Example, voluntary retirement. That means the entity is giving an option to all the employees that whoever wants to leave the job can leave today, because we don't want so many employees and this particular amount of cash will give you and you can leave. So like that they will tell the employees to retire and go. The entity is telling the employees to retire and go. Okay. Same way retrenchment also, the entity will throw them off and in against them they will give some money to them as a compensation. Okay. So these are the four types of employee benefits. It is short term and long term, which is paid during the employment. Post employment is either on retirement or after retirement. Terminal benefits is at the time of termination. When the company is terminating them, they will pay it. Okay. So these are the four types of employee benefits. Hope this was clear to you. Okay. So now this AS 15 is applicable to whom? So this AS 15 is applicable to all level 1 enterprises. So this you need not understand much in detail. Just understand in case if MCQ is asked. Hope I don't think so. It will come from here, but still because it's given in your book. So it is applicable on level 1 enterprises, and for other than level 1 enterprises, certain exemptions are given. So they need not apply all the time. On level 1 enterprises, compulsorily it is what do you say, applicable. For other than level 1 enterprises, certain exemptions are given. If they don't fall under the exemption, then they will have to apply. Okay, so example here, one of it is depending whether they have employed 50 or more employees, some exemptions would be given to them. Okay, not that important. Fine. So now we have completed our first page where we understood completely about employee benefits. What does it mean? What are the types of employee benefits, etc. Okay. Next topic we are going to move on to is short-term employee benefits. Now here we saw, right, what are the types of employee benefits. So types of employee benefits we had read four types, in which short-term employee benefits now we are going to learn and understand in more detail. Now we are going to understand in more detail. Okay. So short-term employee benefits. Fine. So short-term employee benefits can be of four types. Again, there I gave you an example. Example can be salary or wages. Salary or wages was one of the examples for short-term employee benefits, correct? So here now I'll divide the short-term. So apart from salary and wages, there may be even more kinds of short-term benefits, correct? Even more kinds of short-term benefits can be there. So that has been divided into four parts. Your regular benefits is nothing but your salary and wages only. Regularly you get it. This is not something extraordinary, correct? And then you have something known as short-term compensated absences. Absences means what? You're not there. You're on leave. You are on what? Leave. So what is short term? Short term means for less than 12 months you have got some leave. Now, what is compensated leaves? Compensated leaves means you will take the leave. Usually when you take a leave, what happens? When you take a leave, your salary will get cut. Your salary will get cut. Correct. But here what they are saying, it is a compensated absence. Compensated leave or compensated absence means in this case your salary will not get cut. Suppose in few companies, few or most of the companies actually have this policy where they tell you that in 1 year you are allowed to take 10 days of compensated absences, or you can say 10 days of paid leave. Paid leave means it is a leave but still you'll be paid for it. So like this, they'll have some policies, etc., which is known as your short-term compensated absences. Now, it in simple words, it is nothing but your short-term paid leaves. Okay, fine. Next is your profit sharing and bonus plan. So bonus also comes under. So because if in this year you're going to get this bonus, it will come under less than 12 months. So it will become your short-term employee benefits. And finally, some non-monetary benefits also you can get. Okay. So now importantly, you have to focus on three areas. One is your regular period benefits, short-term compensated absences, and profit sharing and bonus plans. These three, if you read, your short-term employee benefits will completely get over. If these three topics you understand, then your short-term employee benefits will get over. So now let's start from the first one, which is nothing but your regular period benefits, or what I told was nothing but your salary or wages. So salary or wages, how do you usually account? So now we are going to understand the accounting of all these three aspects. Okay. So starting with salaries and wages, so how do you account this? So this is nothing but your employee benefit expense. It is for the benefit of the employee, so employee benefit, and it is an expense to the company. Correct. So it is your employee benefit expense. So salary and wages from now on in this AS 15, you will not call it salary and wages. What are you going to call it? You're going to call it employee benefit expense. Okay. So you have to record this employee benefit expenses in the books of the company in the period in which the employee has rendered the service. So you should not, here you have to follow accrual concept. You have to follow accrual concept. You should not record it when you have paid it as an expense. You have to record it when the employee has performed the service itself, when the services has been performed. Then in such case, you have to record it in your books. Okay. Any difference amount between the expense which is being recognized and the cash payment, that means expense is recognized this year itself, but you have not yet paid. The employee has rendered their service, but you have not yet paid to them. So there is a gap between when you're recording the expense and when you're making the cash payment. So in that gap, so that difference amount which is going to get arise, that will be either treated as an asset or in liability as the case may be. So now we are going to understand when it will be an asset and when it will be a liability. Okay, so usually what is the journal entry? So it has been accrued, that means the employee has rendered the service and you have also paid the salary to them. So it will be, so in such case, the journal entry is going to be employee benefit expense account debit. Okay, so you're recording an expense, you're debiting it to bank account because you have paid. So it will be to bank account. So employee benefit expense account debit to bank account. So this will be a journal entry when it has been accrued and also it has been paid. Second case is when it has been accrued. That means they have rendered the service, but you have not paid it yet. So in such case, it is your liability to pay to that employee. You are bound to pay to that employee from an entity's perspective, you think. So it will be nothing but expense, you have to record it, like I told you. So it will be expense, employee benefit expense account debit. Two, you cannot write as bank account because you have not paid it. So to salary outstanding account, you will create a liability. So whenever you are going to pay to them in the later future, you will reverse this liability. Okay, third case is when you're paying it in advance. That means yet the employee has not given you any service, but you have already paid them the amount. That means the employee is obliged to give the service. So here you are the king. Now they have to give you the service. So it's an asset for you. So prepaid salary account debit, you will create an asset to bank account. And whenever in the later years employee renders the service, you will reverse this salary. That means next year's salary, this year itself we have paid. So next year when they render the service, you will reverse this asset. Okay. So I hope you understood these journal entries. Fine. So this was all about your regular benefits or what you call as salary and wages. Okay. Next, we are going to see about bonus or profit sharing plan. So, bonus, it is nothing but a excess payment to the employees, okay, other than their normal or regular benefits, to, give them a boost or give them a motivation. Example, your Diwali bonus that you give, or in few companies they give something known as a performance bonus. That means based on the performance they will give you some bonus. If you do good performance, then good bonus they'll give you. In articleship firms also you'll have, your normal suppose stipend is 15,000 rupees. They'll tell you that in the whole year if you do some good job, or if they think you're credible enough, they'll give you 2,000 extra and 17,000 you'll get as your total stipend. So like that. Okay, yes. So normal bonus, how are you going to calculate normal bonus? What you'll do is, how much is the, for the company we are calculating is for the company as a whole, how much will be the cost, how much will be the bonus cost. So it will be bonus per employee, how much you are paying. Suppose per employee I am paying 500 rupees as bonus. How many employees are there in your company? How many employees are there in my company? In my company there are suppose 20 employees. So 500 per employee I'm giving to 20 employees, then it will be totally 10,000 rupees will be your bonus amount. So I hope you understood this calculation. This is when you normally give out bonus. Now there is one more type, which is your profit sharing plan. So here what the company will tell to their employees, the company will tell you, listen, this year we are going to target 10% of profit. Yeah, this year we are going to target 10% of profit. If you all help us in achieving this 10% of profit, then 1% of the profit will distribute to you. 10% is our goal. If we achieve this 10% goal, if you all work hard and work good and let us help us achieve this 10%, then 1% of that profit, 1% of that 10%, we will distribute it to the employees itself. So you all can also enjoy the benefit of it. Not only the company, but employees will also get it extra. Okay. So here, how will you calculate how much the employees will get? What will be the cost to the company if they earn that profit which has been targeted? So what will be the profit which is earned by the entity during the year? Suppose they have earned a profit of 10 lakh. So that was their target, and suppose they have achieved it, 10 lakh rupees of profit. What is the share in profit which is expected to be paid out? So how much share in profit? Now if they have achieved, how much you have to pay? You have to pay 1%. So 1 lakh will be your profit sharing plan amount. But some cases what might happen, here, suppose in the starting of the year there were 350 employees, or suppose let's take an easy number, there were suppose 1,000 employees. Okay, and as the year end came, you have to pay bonus to them because they have achieved, or profit sharing plan. Under profit sharing plan, you have to pay them a certain amount because they have achieved the targets. But by the year end, there were not 1,000 employees, there were only 500 employees left. So now in the starting of the year, if you had to pay 1% to them, now because it has reduced to half, only 0.5% of the profit will go out from the company. So only 0.5% you will have to pay out. So that is your expected payout percentage. That means at starting of the year you would have decided. But now depending on the circumstances, how much you're paying, or mostly it is because of decrease in numbers of employees, you will pay less. Okay. So like that you have to calculate. So this was all about your bonus or profit sharing plan. Okay. The next one we are going to now learn is about short term compensated absences. This is one very important topic which you have to understand, this and what we are going to read next. So this 2 pages, this 2 to 3 pages is the most important part in the chapter, where you might, have a little bit of confusion, but I'm going to make sure everything is very clear to you. So please pay attention. Okay. So next is short term compensated absences, which I told you in simple words is nothing but paid leaves which you will get. See, here I've written leaves for which salary will not be deducted. That means how much ever you are normally getting, that you will get. So that is nothing but your short term compensated absences, or you can call this paid leave. Okay. So here there may be two cases in a company. First is that this paid leave, which we are now understanding as compensated absences, it can either be accumulating or it can be non-accumulating. Accumulating means what? Accumulating means in 1 year, if I have given, suppose in year one, I have given them 10 paid leave. I'm telling you, in a year, in every year in your employment, you can take 10 days of paid leave. 10 days of paid leave means what? 10 days of paid leave, does it mean that it means Sundays? The answer is no. Sundays is a normal holiday, not that. Does it mean public holidays? The answer is no. Not Sundays, not public holidays. Apart from that, in your working days, you can take 10 days as paid leave. Suppose after Sundays and public holidays have gone by, you are left with some 350 days as working days. In this 350 days of working days, you can take 10 days as paid leave. You can take as 10 days as paid leave. Okay. So here what happens, the company tells you that, let's first understand non-accumulating. Okay. So your company tells you that in this year you have to take 10 days of paid leave. If you take, well and good, will not cut your salary. If you don't take, next year you cannot carry forward it. Suppose in this current year you only took 2 days of paid leave, 8 days of paid leave balance is still there. You're going to your boss and asking, this year I did not take 8 days leave, next year can I accumulate it and take 8 days extra? So next year again you will get 10 days of paid leave. Along with that, you are asking your boss that last year 8 days I did not take, so next year I'll take those 8 days also, so next year can I totally take 18 days of paid leave? The boss will say, get lost. The answer is no. If it is a non-accumulating type of compensated absences, the company policy, it will be written. So the unused leaves which you have, this 8 days of unused leave, which you had, it cannot be carried forward to the next year. In this year, if you use it, well and good. If you don't, then it is going to get lapsed. So that is all about your non-accumulating. Okay, non-accumulating type of compensated absences. Here in our AS, there is no accounting treatment for it. So the important one is what now? For which accounting treatment has been prescribed? It is your accumulating. Accumulating means next year you can use those unused leaves. So here what they are saying is, this unused leaves which is there, it can be carry forward to next year. So here again there are two types. Vesting and non-vesting. So you will tell, what is two types in this? This year we did not take leaves. If in non-accumulating they are saying that you should not take leave next year, that means here they will say that you can take leave next year, correct? So you are entitled to take leaves in the next year. That is your non-vesting. That means it is non-vesting. That means next year again, say 8 days which you did not take this year, next year you can carry forward and take it. Okay. You can take leaves in the next year. Here there is one more kind where they tell you, see, next year we will not allow you to take leave. Next year will not allow you to take those 8 days as leave. Instead, what you can do is, whatever your unused leave balance you have that you did not use this year, this 8 days you can encash it in the next year. That means against this 8 days, next year will give you money. So this year you worked 8 days. Actually you should have gone on leave, but you worked for us, you are such a hard working person, so don't take leave next year, instead take cash from us. Okay, so that's what they will tell you in vesting, okay, type. So I hope you understood this. So there is non-accumulating, where you cannot use the unused leave in the next year. Accumulating, where you can carry forward it to the next year. Where non-vesting means you can take it in the form of leave, vesting means you please take it in the form of cash. Okay, so these were your bifurcations of short term compensated absences. I hope you understood it. Okay, next is, how are you going to calculate the number of days? That means how much days of leave compensation you are going to get. How will you calculate it? Why do we have to calculate? Why should we do all this calculation? It is because we have to create a provision. We have to create a provision for this. That means next year, to a particular employee, this much amount of much particular amount you have to pay as cash, because in this year, so example, let me make you understand an example. So here, suppose in the current year, 8 days of leave I did not use it. In the next year, so per day, my per day salary is suppose 1,000 rupees. So in the next year, if the company is telling me that you fall under the vesting condition criteria and we fall this vesting condition, that means next year for this 8 leaves, what you're going to give me? You're going to give me cash. So 8 leaves into 1,000 rupees of cash. So 8 days into 1,000 rupees per day. So 8,000 rupees you have to pay me. So for that, you have to create a provision this year itself, because this year itself, you know that next year, of course, they are going to go and get the payment. I mean, that company will have to make the payment to the employee. So already, if you know, so current year, please make a provision. Okay. So that is why we are understanding what is the calculation of this leave compensation. So if it is a vesting condition means here you are getting cash in return. Cash in return. So so will any employee come and tell you that no, I don't need cash, company, please keep it with you? The answer is no. All the employees who have some unused leave balance will go and get cash against it next year. Nobody will say no to the Lakshmi that's coming in, or nobody will say no to the money that's coming in. Correct? So here you have to do total number of employees. Take all the employees who have unused leave balance, take them. Okay, see how much total number of unused leaves they have. Suppose there are 10 employees, and each employee on an average they have 2 days of paid leave balance which they have unused, which they have not used until the year end. Okay, and their salary per day is suppose 1,000 rupees. So next year, how much will you have to pay? What will be a leave compensation provision which you have to pay next year? 10 employees and 2 days of leave everyone has, and 1,000 rupees you will have to pay. That means 20,000 rupees in total you have to make a provision which you will have to pay next year. So per employee, how much? For one employee, 2 days of paid leave into 1,000. So per employee, 2,000 you will have to pay. For 10 employees, 20,000 you will have to pay. So 20,000 will be your leave compensation provision that you have to create and pay it in the next year. I hope you understood this. Now, when you come in the case of non-vesting leave, here how will you calculate? So here in case of non-vesting, what it means is you're telling the employee that, listen employee, 8 days of paid leave you have not used this year. Next year, please use it. Next year again you will get a 10 days of paid leave plus. So every year, what they tell, every year you have 10 days of paid leave. So this is a normal opening balance which you will already have. Apart from this, because previous year you did not use this 8 days of paid leave, this 8 days of paid leaves also you can use, and 18 days of paid leave you will have. So now not all employees will be able to take such 18 days of paid leave, because such a long leave it is, correct? So not everybody will be able to use it. So here you have to use some estimates, because the company don't know what is going to happen in the next year. In the current year itself, you have to create a provision for the next year. So here you have to use some estimation. So you will see how many number of employees are expected to utilize the unused leave in the next year. Suppose number of employees we are expecting, who will use, they are very bad people, they don't think about the company at all, very bad, very bad. So they are going to, suppose there are 5 employees like that, how much number of unused leave will they be able to utilize? They have 8 days of unused leave, 8 days of unused leave. But I am the boss, I'll not give them 8 days of unused leave, I'll only give them, I'll tell from this 8 days of unused leave also, only 5 days of unused leave will be able to use next year. So 5 employees, they will, out of the 8 days, they will only be able to use 5 days of unused leave as a, they can take as leave, and their salary per day is 1,000 rupees. So 5 into 5 into 1,000, so 25,000 will be your provision. So 25,000 is going to be your provision here. Okay, so I hope you understood this. So this is your provision which you have to create against non-vesting leave. So I hope you understood this. So here now you have to understand a note particularly. Okay, so in this note, what they are saying that if the question is going to ask you what is the total employee benefit expense in a year, how what will be that? It will be how much salary you are paying. That is going to be your expense plus whatever provision you are creating. That will also be your expense. Okay. Yes. So here in this case, this will be a total employee benefit expense because what will be your provision? And your provision is a liability. So you're going to do employee benefit expense account debit to provision for leave absences or for compensated absences, something like that. Correct. So this is going to be a total employee benefit expense that you're going to record in a year. Fine. Next is they are saying that leaves can be utilized either on FIFO basis or LIFO basis. First in, first out means previous year you had some balance and current year you had some balance. If it's a FIFO method, then first you'll use the previous year leaves and then you will use the current year leaves. If it is a LIFO method, then you will use the current year leaves first and previous year leaves later. Okay, suppose 10 days of leave I am taking. So this 10 days first will I deduct from the current year leave balance or previous year leave balance. It will depend on the method that you're using. Usually it will be a FIFO method. That means first previous year leaves, whatever balance, unused leave balance you have, you will exhaust it first and then you will come to your current year balance. That is your FIFO method. Correct. That means first whatever is older, exhausted. But if the question specifically tells you that you are going to use LIFO method, then you have to first exhaust your current year leave and then your previous year leave. So now what is going to be the difference because of this FIFO and LIFO? There is going to be a difference. Okay. So you have to remember that suppose 10 days of leave you have taken and first if you're going to exhaust it from current year leaves, the previous year leaves you cannot again carry forward it to the next year. Suppose only you can carry forward of leaves you can only do for 1 year. That means if this leave balance is still pending, you will not be able to carry forward it. Whereas if you first exhausted the previous year leave and current year leave balance you had, you could have carry forwarded this, you cannot. Yes. So like that there will be some differences. So if the question is silent, assume that it is FIFO method. That means exhaust your unused previous leaves first. Okay, done. So I think there's a question on this where you will be able to understand it better. You will be able to understand it better. Okay. So now this was all about your short term employee benefits. So short term employee benefits we have completed. Next we are going to move on to post employment benefits. Now next we are going to understand post employment benefits. So if you understand this, then your topic gets over. Now before we move on to this last topic, can we quickly do a revision again? So first we read what is employee benefits. I told you all forms of consideration you can take. Then we read some basics about it. Then we read what are the types of employee benefits, where I taught you there are 4 types. Then about short-term employee benefits we studied, where we studied about salary and wages, your bonus and profit sharing plan, then about your compensated absences. Now all that is over. We are moving on to post-employment benefits. Now we are moving on to post-employment benefits. So here specifically about post-employment benefits, only 2 things you'll have to understand. One, you have to first understand what is the difference between defined contribution plan and defined benefit plan. First you have to understand the difference. Second thing that you have to do for your sums, to solve your sums, is this defined benefit plan. You have to understand the calculation related to that. If we do this, then our AS 15 will get over. Okay. Yes, so let me give you an understanding of what this topic means in general. Okay, so here what happens is that post employment, we are reading about post employment benefit. So what the company, or what we can say as what the employer has to do is, after the employee has been done with his employment, that means post the employment of this employee, they will have to give some what do you say, benefits. They will have to give some benefits to the employee. Okay, so this is more like a long term. So this is more like a long term. So here the employer usually has 2 options. Okay, there are 2 types of funds in which he can put money in, and what will happen is at that end, at the end of such a period, the fund will give those benefits to the employee. Okay, so here there are 2 types of funds. One fund is called as a defined contribution plan. So here what will happen is the employer or the entity will pay a fixed contribution to a separate fund. There will be a separate fund in which every year Okay, or depending on the period, the employer will pay a fixed contribution. And once he has made this contribution to this fund, at the end, that means after the employment is over of the employee, the fund will directly pay money to the employee. So here once a company has paid to the fund, the company's responsibility get over there. After that, it is a fund's responsibility to pay to the employee. So here the employer will not come in between when the fund is paying to the employee. Okay, there is the company will come, pay to the fund, and their responsibility is over. Then the fund will make payment to the employee, and that's their part and parcel. Okay, so then the entity will have no further obligation to pay any amount to the employee. So this is about a contribution plan. Whereas about a benefit plan, what will happen is, even though any plan, okay, other than a contribution plan, will become a benefit plan, to be very precise. Here what will happen is that, irrespective of whatever happens, in the end it is the entity's responsibility to pay directly to the employees post employment. It can The entity itself has to directly pay to the employee. The entity itself has to directly pay to the employee. Okay, so that is a major difference between a contribution plan and a benefit plan. So in contribution plan, what they say is, the actuarial risk and the investment risk, that what happens is, tomorrow if they have to pay more to the employee, or if they have to pay less to the employee, if there is some mismatch in the amount that they thought they will have to pay and what they actually had to pay, all that risk will fall on the employee only, and the employer will not be concerned about it, because employee is not directly paying to the employee, correct? Whereas in benefit plan, because the employer is directly paying to the employee, the actuarial risk and the investment risk both will fall on the employer only. He will have to take care about any changes. Okay. So here, whatever amount in contribution plan, whatever amount you're contributing, you will record it as an expense then and there, done and dusted. In case of benefit plan, here the amount that you are going to record will be depending on the actuarial calculation. Okay, so how much you will have to charge, that will be depending on an actuarial calculation. Fine. Here examples for contribution plan are provident fund and gratuity. So this is the basic difference. The major one that you have to remember was the first point that I told you. Okay, so if you understand this difference, that is more than enough. More content is given on the benefit plan, and more sums are also given related to benefit plan only. So now let's understand that in detail. So in defined benefit plan, there are two, 1 minute, yes. So under defined benefit plan, you have to understand two aspects. One is plan assets, and the other one is defined benefit obligation. Okay, so first we will understand what is defined benefit obligation and how you calculate that. So here, if you see, there are totally 7 steps of calculating the defined benefit obligation. Then you will understand how you have to calculate plan assets. So in the exam or in your ICI material, basically these two calculations only you have to do. Okay, now first let's start with your defined benefit obligation. How are you going to calculate it? Defined benefit obligation is nothing but, post employment, how much are you going to pay to the employee? That is the obligation to the company, correct? The company has to pay to the employee. So post employment, how much are you going to pay to the employee, and how are you going to record it in your book? That liability, how are you going to record it in your book? This is nothing but, this is a liability to the company. How are you going to record it in your books? That you are going to understand. Okay, so now let's understand the step one by one. So step number one, they are telling you, you have to calculate the estimated benefits that has to be paid to the employee. Okay, so at the year end, okay, post employment, after the service has got over, how much benefits are you going to pay to the employee? What is the estimated benefits you're thinking that you will pay to the employee? First, you have to calculate that. How will you calculate that? See, at the end, how much will be the final salary? Okay, at the end of service of the employee, how much will be his final salary? Okay, multiplied by how much benefit percentage you will give. Okay, suppose his final salary is, suppose, 1 lakh rupees. 1 lakh is very less, but okay. For example, we'll take 1 lakh rupees per annum. For a year, he is earning 1 lakh rupees. In that 1 lakh rupees, you are going to give him another an extra benefit of, suppose, 25% extra benefit you are going to give him. So that means 25,000 rupees of benefit. So now for the years of service, he is going to continue in the company. For all those years, 25,000 will start getting accumulated. So starting from today until the time he is in the company, for all this period he's going to get this benefit. Suppose number of years of service means number of years he's working in the company, how much time period he has worked in the company, or how much service he has given in the company. So for the next 5 years he's going to give service in the company, suppose. Okay, so 25,000 into 5 years, it is going to be, so 1,25,000 is going to be the estimated amount that you will have to pay to the employee post employment. Okay, what will be his final salary, what is the benefit percentage you want to pay out of it, and how much years of service he is going to render. All these things you have to get, and 1,25,000 will come as your estimated benefit that you have to pay to the employee post employment. So that is your step number one. Find out what is the estimated benefit. This is nothing but a total estimated benefit. Okay, okay, fine. So after that is then you have to allocate this benefit what you have calculated in step 1, this 1,25,000, over the period of service. That means find out per annum how much benefit will accrue every year, per annum how much benefit is going to accrue. So the total benefit is 1,25,000. The number of years of service is going to render is 5 years. So per annum how much it is going to be, 25,000 per annum is nothing but your per annum benefit. So total benefit is 1,25,000. Per annum benefit will be 25,000 per annum. But this, no, they are not going to pay now. This 25,000 per annum he is earning for every year of service he is going to give. Every year he will earn 25,000. So there is going to be 5 years, 1 2 3 1 2 3 4 5. So every year he works, he is going to earn 25,000, 25,000, 25,000, 25,000, and this he will receive after the end of 5 years. Okay, fine. So second step, you have to find out the per annum one. Okay. Third step, you have to calculate something which is known as current service cost. So what is current service cost? So here we are telling that for the next 5 years, he is going to earn 25,000, 25,000, 25,000. Correct. But when all of this is going to get paid, this is going to get paid, suppose for example at the fifth year end. Let's take it as at fifth year end if he is going to earn so here in our standard they'll tell you that as and when the employee is going to render, as and when the employee is going to render the service, you have to book that expense in your book. So you should not wait until the time you pay. Every year as and when he is going to render that service, the benefit related to that service, you have to record it in your books. That's what we read in the starting. So 25,000 related expense you have to record in year one itself, in the year one end. At year 2 end, another 25,000 you record. At year 3 end, another 25,000 you record. I know you have not paid now. You're going to pay it at the year 5 end only. But related to that, service has been rendered, correct? So please record it now. Now, you have to remember that today it is 25,000 you are recording. But when are you going to get the payment? It's going to get the payment on fifth year end only. So here there is a time gap. So here there is a time gap. So the concept of time value of money comes into play. So here the concept of time value of money comes into picture. Okay. So now let me take this off. Understand better. Okay. Fine. So here what we are saying, suppose year 1, 2, 3, 4 and 5. Every year 25,000, 25,000, 25,000, 25,000 worth of service he is rendering. Okay. Now what you have to do is in first year when you are going to record an expense, you should not record it at 25,000. Okay, because it was equivalent to this 1,25,000 which are going to receive at year end 5. Now you are standing at year end 1. Year end 5 is year. You are standing at year end 1. So today, how much is it worth? You have to find out what is the present value. You have to find out, and at that value, you have to record. Usually, what you do, usually like you will do. Okay, suppose let's take an example that 8% is your discounting rate or 10% is your discounting rate. What you will do? You will do 1 divided by 1.1. So 0.909 you will multiply, 0.826 you will multiply, like that you will multiply and finish it off. But here you should not do it like this. Here something known as reverse discounting will get applied. So I'll not go much in detail about it. Let me explain you it in simple words. Okay, this is the first 25,000, and this you have earned at year end 1. At year end 1 you have rendered the service and earned 25,000. But this 25,000 you will get it after how many years? You will get it after 4 years only. Next 25,000 you have earned at year end 2. But after that, how many years are more to go to get that in cash? Year 3, year 4, year 5. So 3 years are left for you to get it in cash. Same way, 2 years are left to get it in cash, 1 year is left to get it in cash, 0 year is left to get it in cash. So like that, what you're earning today, you'll get it after a certain period. You'll get it after a certain period. That means the year end one, what 25,000 you're earning, you will get it after 4 years only. So here discounting, how you will do is 1 divided by 1 plus r to the power n you are going to do. So 1 divided by 1 plus r is 10%. So it is nothing but 0.1 to the power n. So how many years it is? It is 4 years. It is going to be 4 years. Correct. So it is going to be 1, 2, 3, 4. So here it is nothing but 0.683. So here the discounting factor is not going to be 0.909. Here the years are different. You still have 4 more years. Okay. So here it is going to be 0.683. So likewise it will go. Then it will become 0. Wait. 1 divided by 1.1 to the power 3, right? So it is 0.751, 0.826, I think, 0.901. And here what will happen at the end of 5th year? You have no year left, correct? 0 year left. So here the discounting factor will also become 1, because same 25,000 what you are recording in your books today is what you are going to receive also. At the same time period only you are receiving. So this is going to be 1. Here there will be no discounting factor. So like that you have to discounting. So something known as reverse discounting will be applied here. I hope you understood the concept. Okay. So there's a sum related to this. That's why I've taught you. Okay. So you have to find out current service cost. Current service cost is nothing but the present value. The present value that you're finding out, which you have to record every year in your books. Every year you cannot record as 25,000. You have to record the present value. So that is your current service cost. The present value is in another way is called as current service cost. Okay. So each year you have to recognize the present value of the benefit. That means 25,000 you cannot record. Present value of such 25,000 you have to record, which is attributed to that year. So here no reverse discounting will get applied. Okay. So here how will you record this in your book? So current service cost account will be your expense. So in your P&L it will go as employee benefit expenses. To your liability will get increased. So each year your liability will keep on increasing, and by the end of year 5 the liability will become 1.25 lakh. The liability will become 1.25 lakh. Okay. So that will be your liability. So this is the entry that you have to make, expense to liability. Your liability will increase every year. Okay. So current year, since the employee has rendered 1 year of service, current year 25k worth of liability will increase. Not 25k, you will PV this. Okay, so that much worth of liability is upon the company now. So like that every year, as and when the company keeps on renting the service, sorry, the employee keeps on renting the service, the liability will also keep on increasing, and by the end it will become 1,25,000. Okay. So this was your current service cost. Yeah, the third step you have to find out that. Step number 4, you have to find interest cost. So what is interest cost? This current service cost you're recording at PV, correct? Now you have to unwind it. Unwind it means every year you have to charge interest on it. Okay. So first year, what you did? Suppose we'll also calculate this 25,000 into what was for the first year 0.683 into 0.683. So first year, suppose you are recording 17,075. Now at year 2 end, when you again do the PV and record and everything. So now you have to record the interest cost also. Interest cost also, because here you have PV. Now this PV you have to slowly open it. That means slowly you have to unwind that PV so that it can become equivalent to its future value. So 17,075 into 10%. So 1707.5 you will record as interest expense. Okay, so see, now this and this both will get added, and this will increase your liability. Okay, so interest cost account debit, which will go to your P&L expense, to DBO, your liability will again increase because of that increase in cost, and likewise your future value will come as 1,25,000. So we started with 17,075. Every year the current service cost will also get included, and interest cost will also get included, and by that everything will get accumulated, and the DBO or your liability will come up to 1,25,000. Okay, so here how are you going to calculate the interest cost? Whatever is your opening balance of DBO, which was 17,075, multiplied by the discounting rate, which we had as 10%. So this will be your interest cost that you have to find out in your step number 4. Okay. Next, moving on to the step number 5. So step number 5, you have to find out, or rather this is not something you have to find out. Step number 4 is about actuarial gain or loss. This will be given in the question. So in case, when you are calculating this benefit, etc., you will have some assumptions in your mind. Okay, that means how many years of service will this employee give? how much employees will die, how much employees will leave the company, like that many assumptions you will keep in your mind and find out the benefit, total benefit. Okay, here that assumptions might get changed. So due to such change in assumptions, you will either your liability will increase or either your liability will decrease. Now you thought only for 5 years the employee is going to work, but the employee, if he works for 6 years, your liability will increase. Now if the employee only works for 4 years, the liability will decrease. Okay, so you will have to pay him less. So like that, due to the change in assumptions, your liability will increase or decrease, and due to such change, you can either have a gain or loss. If your liability is going to increase, if your liability is going to increase, you will have a loss. If your liability is going to decrease, you will have a gain. I hope you understood this now. So this gain and loss, where you will have to charge, you will have to again charge it in your P&L. You have to again charge it in your P&L. So actuarial loss account debit you will put. You'll call this not normal loss or normal gain. You will call this as actuarial loss. Okay, so actuarial loss account debit, P&L account debit. I mean, sorry, actuarial loss account debit to your liability is increasing. So to DBO account. Here your liability is decreasing. So DBO account debit to actuarial gain account. Okay. So this will be your fifth step. Due to the change in assumptions, your liability will decrease or increase. If your liability increases, loss. If your liability decreases, gain. And according to the entry, you have to pass. Fine. Sixth is you have something known as past service cost. So now what is past service cost is, here this was due to your change in assumptions. Here what you happen is, you make the company decides to change the benefit percentage. So in the starting we decided that it will be 25 percentage. Now you can change the benefit percentage as either 20 percentage, or you can change from 25 percentage to 30 percentage. If the company is deciding to all the employees, I will pay, instead of paying 25 percentage, I'll only pay them 20 percentage benefits. So here what is happening, here your reduction in employee benefits is happening. Okay, but if the employee says, if the company says that 25 percentage of benefit was what I decided, but I'm very happy with their performance, so 30 percentage of benefit I'll give to them. So here you are getting additional benefits to employee. Okay, so depending on increase or decrease in the benefit percentage, you will incur something known as past service cost. Okay, so here if the reduction happens in the benefit plan, that means 25% you decided you will give, but you're only going to give 20%. That means you need to pay less. If you're going to pay less for the company, if they're going to pay less, it's a gain to the company. So your liability will also get decreased. Due to the gain, your liability will get decreased. So DBO account debit, your liability is getting decreased here. To that, you will expense it off in past service costs. So this will go under your expense. Same way, if you're going to pay additional benefits to the company, then you have to pay more to them. That means it is a loss to you. If you have to pay more to the employees, it is a loss to the company. So here the liability will increase. So to DBO account, liability increases, and past service account, past service cost account, you will expense it off. Okay, so I hope you understood your sixth step. So now until now what you read, so you read about current service cost, interest cost, actual gain or loss, and past service cost. Now finally there is something known as last step is curtailment and settlement. So curtailment and settlement, here what happens is that the entity can do something, which means it can, if the employee is getting some benefit, it can curtail that benefit. That means we were telling that, for 5 years, if the company works, we'll give him this and that. In the third year end, I decide as a company that from today I'll not give him anything. So today itself I'll close this plan, and whatever the amount is coming, I'll settle it. For the next 2 years I am not going to give him any benefit. So this is that abruptly or curtailing something. So the entity is curtailing the benefit which is given to the employee. For 5 years he should have got. At third year end itself, the company is saying enough, now close this plan. Okay, and they are going to settle whatever amount is going to come before maturity itself. So here what will happen, your liability will get decreased because they are curtailing the plan. So here your liability is going to get decreased. So DBO account debit, and then what happens, you are going to pay it off to the employee, like I told you. So to bank account you will pay for the settlement amount, and then whatever balancing figure you get, either it will be a loss on settlement or gain on settlement, and accordingly you can account for it. Okay, so I hope you understood this. These were the 7 steps of defined benefit obligation. So first you find out the total estimated benefit. So first you find out total estimated benefit, then allocate it over the period of service, find out current service cost, interest cost, actual gain or loss, past service cost, and then finally curtailment and settlement. If you do all of this at the end, you will be able to understand how much DBO is left in the company at the year end, how much DBO is left with the company after doing all these adjustments, how much it is left. So this was all about your DBO, which was your defined benefit obligation. Now moving on to our last topic, which is nothing but plan assets. So now let's understand what is plan assets. Fine. So what is plan assets is basically every year you have to make this defined benefit obligation, or at the 5 years end you will have to pay a certain amount of money to the employee. So now this certain amount of money to the employee to pay to him, what you are doing is you are going to invest some money every year in some plan, so that what happens is you get enough cash so that you are able to pay off this defined benefit obligation. So this investment what you make outside, so you can pay off this defined benefit obligation at the 5 years end. This investment is what is known as your plan assets. What is known as your plan assets. So this is nothing but a planned savings you're making so that you'll be able to meet the obligation of defined benefit obligation after 5 years. So this investment or savings is known as your planned assets. Okay. So here what will happen, how will you prepare this? So this is an asset to you, this is nothing but your investment. So this is an asset to you and you name this account as plan assets account. Okay. So your first opening balance, you'll have some investment you would have already done, so there'll be some opening balance in it. And in the current year you can make some contribution. Suppose already you had 1 lakh rupees in the account. The current year you again contributed some 20,000 to this. So to bank account, where bank you have made some contributions, so 20,000 will get added. Now in the current year, you could have also, what you would have done is you could have done some benefit you could have paid off. That means you could have withdrawn some amount. You could have withdrawn some amount and paid to your employees in the current year who are leaving the service in the current year. So in case it's a withdrawal you have made from this investment to pay off the expenses or to pay off the benefits, then in such case you have to reduce it. Okay, I mean reduce it means you via bank you will pay it off. Okay, fine. So this will happen. And then in your question, basically they will give you the closing balance also. The closing balance usually will be there in the fair value. So they'll give you two, one they'll give you present value, one they'll give you fair value. So here fair value only you will have to take at the year end. What is the fair value of the plan assets, that only you have to put it as your closing balance. Okay, so that means for your investment, what is the fair value that's in the market, so that fair value only you have to record your closing balance at. Okay, fine. So here then what happens is, on this basically on this opening balance and on the contribution that you have made, on all that amount you will get some interest also. If you're going to invest, what you're going to get in return, you are going to get some interest. That interest is what you call as expected return on plan assets. That means how much you expect to get on it. So that expected return on plan assets you will write here, that is the interest cost that you get out of it. Okay. And after all of these things, whatever is left will either be your gain or loss. I hope you understood this clearly. Fine. So in our book, actually about this actual gain or loss, there is no mention. The other parts will be available to you. Fine. So whatever the balancing figure is, that will either be your gain or be your loss. Okay. So this was about your plan asset. So you will have an opening balance, you will make some contribution, you may also withdraw the amount and pay off the benefit. And then on this contribution, you will earn some return on the opening balance and contribution. So that expected return will come here. And then there'll be a closing balance which will be valued at fair value. Okay. Now here there is some question specific note which tells you that in the question, sometimes what they will tell you that the opening balance was there from the start. So this will come for 12 months. But the contribution they have made half yearly. That means in between, in after 6 months, they have made a contribution, only 6 months in a year is left. So how will you find out the rate for this 6 months? How are you going to find out the rate for the 6 months? So the conversion of expected return rate per annum to half yearly charging rate, how will you convert? So this is basically a compounding rate, a monthly compounding, I think. So it will be a compounded rate. So how will you find out a 6 monthly rate? So directly you cannot do into 6 by 12. No, you cannot do that. You have to apply a formula which will be 1 root of 1 plus r minus 1. So 1 plus r means, if suppose 10% is our expected return per annum. Okay, so it will be 0.1 under root minus 1. So whatever answer comes here, this will be your 6 monthly charging rate. So 6 months contribution, you have to use this rate to find out what was the return out of it. Okay, so when you are doing the sum, this point you'll be able to understand. And then calculation of expected return, how are you going to this point? For this calculation it is given here, how are you going to calculate it? First 6 months you will calculate whatever your balance brought down is there. On that you will have to apply the charging rate. The charging rate is nothing but this month, so 6 months charging rate apply, and for 6 months find out what was the return on the opening balance. After that, in the second 6 months, they'll tell you in the question that a few contribution was made, benefits was paid, etc. So what you have to do is you have to take what was the opening balance, plus in the first 6 months some return you have earned, take that also, and plus contribution if you have made any, take that also, and out of it if any benefit you have paid, reduce that. After this is done, on that again apply the 6 months charging rate. So yearly, first 6 months you calculate, then second 6 months you calculate, like that you'll get an yearly expected return. This both point is a question specific point, you will be able to understand better when we do the question. And final point is, in your question they'll tell you find out the actual return on plan assets. So what is actual return on plan asset? It is nothing but expected return plus or minus actual loss or gain, that will be your actual return on plan assets. Okay, so yes guys, so I hope you understood plan assets also. So this was all about your post employment benefits. Yes, and with this your as 15 gets over, and I hope I was able to make it simple for you in a short time also. If you truly found this video helpful, do comment down in the do make sure you comment down below, because a lot of videos are not available on as 15, and if this video, by you commenting, if this is able to reach a lot of students, it will be of help to them. Yes, so thank you so much for watching until now. The notes will be available on my Telegram channel, the link of which is in the description box below. Use that. And if you have watched until here, thank you so much. Please make sure to like, share, and also subscribe to this channel, and see you in the next video, guys. Thank you.